In the past few years, there have been a talk that a big bubble is brewing in the index fund, ETF, and passive investing. And today we're gonna be talking about it. So first up, we are back again. The S&P 500, it is back to its 6,000 points, back to its high before Trump even initiated a tariff against Canada, Mexico, and also Europe.
Too busy to find stock ideas? Check out Fire Pro to shortcut your research time and effort by 90%. 10% off link in the comments and description.
So I think the market has been pretty much used to Trump fake kind of like tariff threat. I mean, you can see that on the first day, he announced a very, very big fat tariff, like let's say 100%. The next day, he'll start to chicken out and then he'll say that, you know what, I'm just going to give you like maybe 10 to 20%. It's basically his negotiation tactics, and the markets are pretty much, they have already seen through, or they have seen enough already of this trickery, and hence you look at the S&P 500 is back to its high again. Now, why it is back is because there has been a lot of inflow in terms of the index fund or ETFs. So you can see that the inflows for year to date for equity, it is about 270 billion USD, and what they actually bought is actually coming from the Vanguard S&P 500. I think this one, it is a very, very popular index fund among the, I would say virtually everywhere. Even famous YouTubers are actually preaching and telling their subscribers to actually buy this kind of index. Even Warren Buffett, I think it was like 2 to 3 years ago, he did mention that, you know, if you are an investor who like to buy stock market but you don't have any time to research about it, then you can actually just look at index fund. So you can see that obviously there's a lot of inflows that has been going into the market, and it's thanks to this ETF and also index fund kind of like investing. And if you look at the retail's investment, right, they actually bought a record 40 billion of US equities in April. So if you can recall, that is the time period where the S&P 500 dipped a lot over here. So there was like some sort of like a 14 to 17% correction, and that is where they bought a lot. And also we think that for May and June, they are still actively buying the market just because they have like spare cash on the side, and so they decided to use that money to invest in these US assets. And that actually made the passive investing to actually surpass active investing. So if you see, this is actually from 2023's numbers, but even 2023 already, you notice that there is a rise in terms of passive investing kind of like movement. So if you look at the historical fund asset, historically active fund asset surpassed passive until 2023, where there is more retail investors are buying into the market. So, and they are pretty much, they don't want to actively research their stocks, right? So they want to find asset class where they don't need to spend their time researching a lot of, wasting their time in terms of researching stocks. So they decided to park their money into an index fund and do some sort of like passive investing. So they don't need to monitor, they just buy and never sell. So you can see that the passive asset fund actually surpassed the active, just because there is more interest in that. And that actually resulted the earnings or price to earnings ratio for these companies to report at a very sky high valuation. So you can see the difference between the price to earnings ratio or PE ratio for 2015 versus 2025. For Apple, it's actually quite astonishing to see that they are trading at a 12 times earnings. That's a very, very attractive valuation. And right now it is actually more than double to 31 times. And the one that is actually very, very ridiculous is this, which is Costco Wholesale. This is a retail business. It used to trade at 27 times price to earnings ratio. And even Charlie Munger back then, he got mentioned that the price for Costco has been pretty much premium, but he has never been selling his Costco share. He loves Costco, but he thinks that the valuation is pretty much ridiculous. And then 10 years later, it is even more ridiculous at 61 times PE ratio. So right now, we're actually looking at the price to narrative ratio. So what this means is basically investors are looking towards brand names that are well known. So for instance, Apple or even Costco and Walmart, right? So these three are the names that, you know, investors, they buy their products before, they got shop in their retail stores before. Hence, since they are familiar with it, they are more inclined to actually purchase the stocks. And also thanks to a lot of the YouTubers who has been telling their subscribers or followers to buy what they understand and also buy things that they personally purchase before. Hence, they decided to buy most of these companies that is mentioned in the list. Whether this is a bubble or not, well, for sure, we can say that the margin of safety, it is not very attractive because of a high valuation. And also, it is the expectation for these companies to grow even more in terms of their earnings and cash flow is getting even harder, right? Because the market is anticipating them to grow maybe 10, 20 to 30% in terms of growth for their bottom line. So if let's say they didn't manage to meet this expectation, well, then you know what happened to the share price. So the big question is, when will it pop? This is a $1 million question. Nobody knows. But one thing for sure is that the Shiller PE ratio, which basically just measure what is the S&P 500's valuation at the moment, is actually coming close back to around the 2019 era. So 2019 also, it was a period where it was a high inflation era, and also high inflation plus high interest rate, and also the business prospect wasn't so good, and we are going back to that level again, and we are pretty much close to the .com, which is the 2000 kind of like level of valuation. So this is definitely a concern because the margin of safety, the attractiveness to invest right now doesn't look so good. And if you look at the 75-year high in terms of the US stocks over here, you can see that the Magnificent 7 or the S&P 500 actually surpassed this standard deviation by multiple folds. So you can see that people are even more bullish compared to the .com era and also the Nifty 50 era. So it's definitely a concern to see that how long this high valuation will last. I mean, it can last for another year or two, but also it could pop anytime soon. Just because, if let's say companies start to announce bad earnings, well, everything will start to tumble. Now, this kind of like phenomena is similar to the Nifty 50. Now, I'm just going to read some of this passage to you. So throughout the 1950s and 60s, a lot of famous name or household names like McDonald's, Johnson & Johnson, PepsiCo, Gillette saw their share price soar. This is similar to right now, where Costco, Walmart, Apple's share prices are going up. So investors fell in love with a small group of stocks that they believe are so attractive, they only had to make one decision, which is to buy and hold. They never sell. So that actually drove up one of these stocks, which is Polaroid. So this one also is another well-known stocks among the retail investors back in the days. The share price to go up to 90 times earnings. And the S&P 500 peaked around 19 times in 1972. So, you know how the story ends. Polaroid's popularity peaked in 1977, and then it tumbled 90% after I think they didn't really manage to report good results. So it is kind of like similar to the Nifty 50 in the 1970s at the current moment. So what this means is that investors are actually paying a lot of attention towards the Magnificent 7, whether this AI boom run can help them to increase their profits and cash flow. If they couldn't, well, we already know that history doesn't repeat, but it rhymes. So whether it will happen or not, well, we shall see in the next few coming months or maybe even year. And also there's this comparison between S&P 500 and Nifty 50s in terms of their share of US market. So you can see that at the moment, S&P 500 represents 80% of the US market cap, whereas the Nifty 50 represents around 25 to 35%. And you can see that it actually peaked around 1960 to 1970s. I think it started to tumble around 1977. Whereas for the S&P 500, it has still been soaring. I mean, as of today, it is still going up right now it's around like 6,000 points. So if it starts to tumble, well, it's going to be very ugly because it's representing 80% of the US market. So I mean, it's quite of an interesting time whether this bubble will continue to grow bigger or will it start to pop. And if you can see right now, what institutions are doing, professional investors, which is over here, the light blue color, they are actually selling out the market, whereas the individual investors or the retailers, they are actively buying into the market. So there is a difference in terms of their buying behavior. I mean, the professionals are getting more cautious with the market. Some of them are even shorting. I'm going to be showing you guys the chart later. Whereas for retail investors, they are just buying because they just think that the market is going to go up forever. Now, if you look at hedge funds, you can see the long to short ratio on the left over here is at its all-time, I would say 5-year low, which means there is more short as compared to long, compared to 2020. And also, if you look at this graph over here, which is on the right hand side, they actually added more short bets on US equities because they think that the US stocks are currently very, very high. So they think that it's not so attractive, and they foresee there'll be a time where there will be a major correction in the US market. Interestingly, also, they actually bought more of these gold. Not only just retail, but institutions are also actively accumulating. You can look at the numbers of articles are being written, right? It's actually increasing quite a lot over the past few months. And also, if you look at the top right, in 2022 and 2020, late 2020s, actually, I think there is a period of time where the geopolitical tensions start to increase a lot, and the market did tumble a little bit around that time. Not a little bit, but quite substantial. And right now, we are also going towards a similar peak to 2022 and 2020. Well, I'm not going to speculate much already. Whether it will happen or not, we shall see in the next few months. And you also can see that the central banks are still a net purchaser of gold, although it did slow down starting from April for the second consecutive month. And if you look at in terms of recession prediction, the retail side obviously thinks that there is no recession. Right now, the probability rate of a recession happening in 2025 is now 26%, as compared to like previously in just like past few months, it was once around like 68%. And whereas for the CEO's confidence, about 80% of the CEO that got surveyed in this index, right, they mentioned that they foresee some sort of like recession in the coming 18 to 24 months. And they are pretty much being very bearish with the market. Some of them also see that their business are being impacted a lot. And if you look at the lows, it's actually similar to the 2022's correction and also for the 2020's correction. But yeah, so everything is pretty much pessimistic in terms of the professional investors, CEOs, and also institution hedge funds. Meanwhile, the retail investor think that everything is just fine. So here are the final thoughts. Well, I think Buffett is partly kind of like blamed for this because he kind of like created the herd of investing in index fund, right? So I'm just going to quote over here. By periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. Now, he said this 2 to 3 years ago, or maybe even 5 to 10 years ago, he got mentioned about index fund. Right now, obviously, it might not be applicable at the moment because of the valuation. Because investors also look at valuation. If let's say it is too high or it's too premium, definitely it is not wise to actually buy, right, at such a high risk, because the expectation for the company to announce better earnings gets even riskier and even higher. That's why if you are thinking of getting into index fund or ETFs, you may want to reconsider and try to maybe spread out your bets. I think that is to be safe at this current market. And the second big point is that the Berkshire Hathaway actually sold their entire positions for the S&P 500. So they sold 2 ETFs. One is the Vanguard ETF. The other one is the SPDR ETFs. And this is actually a very, very small position, but it kind of like tells you already that Buffett and also his team basically thinks it is not so attractive to stay invested in these 2 indexes. And the third point we have over here, which is the 10% annual return expectation. The reason why a lot of retail investors actually they went into the S&P 500 in the first place is because they think that the S&P 500 can help them to generate 8 to 10% returns every single year. And this is actually not a good kind of like indicator. Well, historically, they did manage to deliver, but you also need to know whether in the future, can they continue to deliver an 8 to 10%. Now, there's a lot of like professional funds, even Monish Pabrai, they did say that the expected return for S&P 500 going forward is around 0 to even 2%. Howard Marks also did mention about this. But so far, the retail investor believe that they can still make about 8 to 10% in the S&P 500. I don't know who is right or wrong, but you guys can make the judgment yourself. Now, last but not least, I want to share with you guys about Munger's thoughts on this, because there is an audience that actually asked about his thoughts about investing in the index fund. And let's take a look at the video.
William Andresian, student at USC, wonderful stories. With regard to the proliferation of index funds, do you think that there may be issues of liquidity anytime we go through another large crisis? And then do you think that that will create large discrepancies between the price of the index fund and the values of the securities underneath?
Well, the index funds of the S&P is like 75% of the market. So I don't think the exact problem you're talking about is going to be a big problem if you're talking about the S&P index. But is there a point where index funds theoretically can't work a course? If everybody bought nothing but index funds, the whole world wouldn't work as people expect. There's also the problem, one of the reasons you buy a big index, like the S&P, is because you buy a small index and it gets popular, it's a self-defeating situation. When the Nifty 50 were the rage, JP Morgan talked everybody in buying just 50 stocks. And they didn't care what the price was, they just bought those 50 stocks.
So Manga did mention that investors are basically just buying stocks that they like, regardless of the price. And this is a very dangerous mindset because when you are buying things that are getting expensive in perpetuity, right? Or obviously the risk for a fall or correction is very, very high just because of the earnings delivery or cash flow delivery or dividend delivery, right? The expectation is getting increasing and rising and it's getting harder to beat. So assuming like, let's say they didn't manage to like announce good results, then you know the herd will start to be panicked and potentially they will start to sell out. And when they start to sell out, well, then means more people will start to like panic and also sell out. And then hence there is a correction or a crash, right? So to speak. So that's why it's very important for you to buy at a company at a valuation that is where the margin of safety is definitely very high and also not at a very, very premium valuation.
And of course, in due time, their own buying forced those 50 stocks up to 60 times earnings, whereupon it broke and everything went down by about 2/3 quite fast.
The key word over here is that they went down 2/3, which is 70% quite fast. So that is the most dangerous part that the S&P 500 might be facing in the future. I don't know. Maybe it doesn't happen. But yeah, I mean, if you think about it, right, if let's say one day you open, your trading platform, you see the market dump 20, 30%, 70%, right? Definitely people will panic and they will start to panic sell even more. So hopefully we don't see that happening, but it is a time to actually take note of these kind of like orange/red flags.
If you get too much fattishness in one sector or in one narrow index, of course you can get catastrophic changes like they had with the Nifty 50 in that former era. I don't see that happening when the index is 3/4 of the whole market. The problem is the whole thing can't work perfectly forever, but it'll work for a long time.
So yeah, Manga also did mention is that with the S&P 500 index being representing 75 to 80% of the US stock market, it is very unlikely for a big market crash to happen. While we don't know whether that is true or not, we can only hope for the best that it wouldn't crash. But if it does crash, hopefully you guys are well prepared for it. I also want to share with you guys with this image is that usually the herd mentality don't know what they are doing. And in this case, you can see that the red, what did they say is that I don't know where we're going, but from the looks of the crowd, it's got to be good. And in the end, they're all jumping down the hill. So you don't want to be the one that is actually following the herd and not know what you guys are doing. All right. And that's about it for today's video. Before you guys go, this is the Fire Pro's May 2025 performance. So far, so good. The Malaysia portfolio, it is up 34.9%. Fire Pro Global and the Boring portfolio, it is up 4%. If you want to know what is Fire Pro about, it is a program where we share our analysis on certain companies that we find interesting. Some of the companies also we may own the particular ideas, right? And also we do share with you guys what are the theses, what are our analysis, what is the catalyst going forward, what is the risk, how's the management like. We also do meet some of these management privately. So if you want to get all of these insights, it is all inside the Fire Pro program. And if you are a dividend lover, you definitely want to check out the Boring portfolio because there's a lot of companies that has a very high dividend yield over there. And we are still actively trying to look for ideas that can command such a dividend yield. And if you are interested to know more about Fire Pro, you can actually read our free sample where we actually disclose with you 2 write-ups. So one is Delium, the other one is KGB. So you can see that as an example, we initiated Delium over here. We bought it at this price and then we also sold it at this price. So if you want to know why did we bought it and why did we sell it, after that, it's all inside these write-ups and you also can read it inside the free sample. And in addition, not only just 2 write-ups, we also disclose to you guys our 3 management notes that we have shared inside the free sample, as well as one of the video about modes, which is inside the SIB program. So that's about it for today's video. Make sure you guys leave a thumbs up and so subscribe if you guys haven't already, and see you guys next week.